Hey everyone, I am re-recording the Class 7 lecture since it did not get posted or recorded properly. So hopefully this time around we will have the full recording, and then I guess there'll be a second recording just of the Q&A section, which did get recorded. So let me go ahead and start. I'm going to start with the screen share, and we'll get started. Um, so real quick. This is the seventh class. This is the one where we're going to talk about. First, I'll talk about the Gordon growth model again, just to kind of go into a little bit more detail. And then I'll go into more about Coca-Cola and the case study, and then talk about some of the key takeaways. So, real quick, I know we've talked about Gordon growth for the last couple of weeks, but really, the way I think about it and where I think the real power comes from it is how powerful it is in terms of just, answering these two questions before investing, right? First question, does the earnings yield alone provide me an acceptable return, right? So when we think about the Gordon growth model, we know the two components, earnings yield and perpetual growth. And I think if you can, the growth function, the future, as we've seen, is kind of the more riskier, unpredictable component. So if you can invest where you know that the earnings yield alone provides you acceptable return, that is helpful. And then do you think the growth rate is at least zero? So is the growth at least zero, meaning your return is at least going to be the earnings yield and potentially very higher? And so I think, if you can answer yes confidently to both of those, then, the answer is yes, you should invest. And otherwise, you should probably wait or pass. And then again, this is just the Gordon growth. As a reminder, this is what the Gordon growth equation is. R, the expected return, is equal to E over P, the earnings yield, plus G, the perpetual growth rate. So hopefully that's a little bit clearer. I will, in next week's class, I saw a request to actually just walk through an example. So I'll use maybe a real example. So let's quickly move to Coca-Cola. The first reading was the 1982 annual report, the section in it specifically called Strategy for the 80s. So what happened in 1982, right? So new management takes over. So his new CEO, Roberto Goizueta, he becomes the CEO, and Don Keough becomes the president and COO. Here's a picture of the both of them. The gentleman on the right is Roberto, and the gentleman on the left is Don Keough. And interesting fact is that back in the late 50s and early 60s, Don Keough, before he joined Coca-Cola, was a coffee salesman, and he lived across the street from Warren Buffett in Omaha, Nebraska. And he apparently turned down investing in the Buffett partnership back then. So if you read the 82 annual report, what you'll see is Coca-Cola was focused on many businesses, right? They were still a dominant, force, and wanted to be and continue to be a dominant force in the soft drinks industry. But they also have a foods division. If you read a little bit further on, they have a business called the Wine Spectrum. They were in the wine business. They wanted to become stronger in the packaged consumer goods business, and they were even talking about entering into services for the consumer. And they go on to say, most likely that we will be in industries in which we're not today. So they were continuing to expand outside of the core soft drinks business. They also talked about being committed to shareholders. So we shall remain totally committed to our shareholders. They wanted to maintain an exceptionally strong balance sheet with very little debt. They said they were going to pay increasing dividends, but that they were going to rapidly or reduce the earnings payout ratio. So the dividend would continue to grow, but it would be a smaller part of the earnings per share, so that they had more cash, more capital to reinvest back in the business. And then they said that they would divest assets that didn't generate acceptable returns. And at the very bottom, you can see increasing annual earnings per share and affecting increased returns on asset are still the name of the game. 1982 also saw the introduction of Diet Coke. So you can read about it here, but basically Diet Coke was pretty much an instant hit. by the end of 82, they had launched it in about 80% of the US. They were going to complete the launch in the US and then also launch it in international markets in 83. They were also undergoing a big restructuring of their bottler system. So the way Coca-Cola works is you have Coca-Cola, the company that we know, and they sell concentrate to bottlers. And so what Coca-Cola had done in the past is that they had created a number of regional bottlers. So, and these are largely family owned and operated businesses that would buy the concentrate from Coca-Cola, combine it with carbonated water and sugar, and then they would have Coca-Cola, and then they'd have the right to distribute Coca-Cola in their allocated region. And so you can see at the very beginning, at the very top, since 1981 in the United States, Coca-Cola had spearheaded transactions valued at over $2 billion to change some of the bottling company ownership to more action-oriented owners. So moving it out of some, sleepy kind of family-owned hands to more driven management teams. And then at the bottom, in the next section, you can see that over the last 3 years, bottler ownership representing nearly 50% of the US population had changed hands to more aggressive management. So basically, they turned over about 50% of the footprint, at least, of the bottlers. And you can also see that they say the bottling contract amendments that contribute to both the bottlers and the division's profitable growth now have been signed, with bottlers representing more than 90% of the volume. So basically, they were improving the terms for of their sales, and basically it was to give Coca-Cola more flexibility in terms of controlling and raising price. Then the next part to know is international. So Coca-Cola, even though it's a US-based soft drinks company, really has been and has been focused for a long time on international growth. So you can see here that international growth in 1982 was about 5% from a unit sales volume, and historically had grown about 8% annually outside of the US. So still pretty robust international volume growth. Now, 82 also saw a big, a big step in the entertainment business. So Coca-Cola, which we talked about earlier, was getting into other businesses. They bought Columbia Pictures and got into the movie business. Why did they really want to get in the movie business? I think even now people kind of question it. The rationale I've heard is that at the time, the international markets were weak and international economies were pretty weak. And so Coca-Cola really wanted to increase more of its revenue and earnings from the United States. The other thing I've heard is that because of Coca-Cola's brand, they thought that there would be a lot of synergy by placing Coca-Cola products inside the movies as a form of marketing. Now, this was also interesting because you don't normally see this in annual reports, but back in 82, they put this table at the back of the annual report, and it basically shows you how, because of inflation, Coca-Cola had really been an economic failure. So if you look, you can see their operating revenue, and their operating revenue hadn't really grown that significantly. You can see this line item, increase in specific prices, over or under the increase in the general price level. And for the last couple of years, it had been negative. And even if you look cumulative, it was negative. So basically, the prices that Coca-Cola charged had lagged, behind inflation. The dividend had gone up in reported numbers from $1.74 to $2.48. But if you adjust for inflation, the real value of the dividend had actually declined from $2.58 to $2.48. And same for the stock price. The stock price had gone up in dollars from $43, a little over $43 to $52, but in real terms, again, had declined from about $65 to $52. So the purchasing price of a stock, the purchasing value of a dividend had not kept up with inflation. So now let's go to the tenure of new management between 82 and 87. Again, the years between when new management took over and when Buffett invested. So over those 5 years, 6 years, you saw a lot of innovation on the soft drink side. So we talked about Diet Coke, introduced in 1982. It was an instant hit. The following year, they introduced caffeine-free Coke and Diet Coke. In '84 was the Cola Wars, the blind taste test that everyone thought made people showed that people really preferred Pepsi over Coca-Cola, which then caused in 1985 Coca-Cola to introduce New Coke. New Coke caused a big backlash where a lot of consumers demanded the return of Coca-Cola, which they now called Coca-Cola Classic. And then they also introduced Cherry Coke in 1985. And then, surprise, surprise, in '86, they introduced Diet Cherry Coke. So that was kind of what was happening in terms of the innovation side. There was a lot of what Peter Lynch would call diworsification, getting into worse businesses, and then followed that by a little bit of refocus and reconcentration. So if we look again in 1982, they bought Columbia Pictures. They got in the movie business. They bought a company called Ronco Foods, which was a pasta maker. And they actually sold a business called Tenco, which was a private label instant coffee and tea company that they had bought. In '83, they sold Wine Spectrum to Seagram's for about $230 million. They got out of the wine business. In 1984, they sold Ronco, the pasta business that they bought. In '85, they bought a company called Embassy and Tandem Communications. They got into the TV making business, the TV show business. They spun off a company called TriStar Pictures. You probably know the name Columbia TriStar today. You'll see why it's called Columbia TriStar. They bought a company called NutriFoods, which makes juice-based frozen desserts, and then they sold a bit of business called Presto Winkler, which was basically making plastic products like utensils and things like that. In '86, they bought Merv Griffin, so that's the producer of game shows like Jeopardy and Wheel of Fortune, and they spun off Embassy and Tandem. And then in '87, they kind of finally spun off Columbia Pictures. They merged it with TriStar, and basically that housed the entertainment and the entertainment business, the movies and the TV that Coca-Cola once had. Now, Coca-Cola was also very active over those years on the bottler side. So if we look in '82, they bought a couple of bottlers. They also, at the very bottom, you'll see 50 to 75% HFCS, high fructose corn syrup. And so basically the way, again, like I said, the way the bottlers worked is they bought the concentrate from Coca-Cola, and then they added the sugar, the sweetener, and then they added the water to make Coca-Cola. Before 1982, Coca-Cola mandated that you couldn't use more than 50% high fructose corn syrup and, again, 50% cane sugar. The reason that the bottlers preferred to use high fructose corn syrup is, it was cheaper, so it would cost them less to make Coca-Cola. In '83, they spun off Coca-Cola Bottling of New York. In '84, they bought some more bottlers, and they finally allowed bottlers to go to 100% high fructose corn syrup, which is why today in the US, when you buy Coca-Cola, it's sweetened with high fructose corn syrup. And if you look at, if you go to some of these restaurants or, stores like Costco or something, they sell Mexican Coca-Cola, which is Coca-Cola still made with cane sugar in Mexico. So Coca-Cola is different if you buy it in different countries. In '85, they bought a few more bottlers. In '86, they actually bought, Beatrice, and then JTL, John T. Lupton, were two large bottlers. And then they also entered into a JV with Schweppes, Cadbury Schweppes in the UK to create Coca-Cola and Schweppes JV bottling in the UK. And then the most important thing is they spun off 51% interest in Coca-Cola Enterprises, which is basically the bottling businesses that Coca-Cola had bought over the years and consolidated. And I think it accounted for about 45% of the total volume when it was spun off. And then they entered into a new contract with Coca-Cola Enterprises, which allowed Coca-Cola more flexibility in terms of setting prices, which we'll talk about down the road why that was important. And then in '87, they spun off, again, 51% of a company that they controlled called TCC Beverages, which was basically largest bottler in Canada. They had about 70% of the volume in Canada. And then they continued to buy some other bottlers. And then, in future years, they would consolidate them and sell them to Coca-Cola prices. And then on the capital allocation side, so in 82, you could see that this was the dividend. This is split adjusted. They paid about 65% of earnings out as a dividend, and their debt was about 13 and a little over 13.5% of their total capitalization. And they said that the maximum amount of debt they would use is 20 to 25%. In 83, they grew the dividend. The payout ratio actually grew a little bit. The debt, kind of went up just slightly. And they said that they envisioned increasing the use of debt to fund attractive investment opportunities. So they told you that they were going to start using more debt in the future. In 84, again, they grew the dividend. The payout ratio went down a little bit. They bought back, 1.5% of their shares, and the debt went up again a little bit as a percent of the cap. In 85, again, they grew the dividend. The payout ratio went lower. They bought back some more stock. The debt to cap went up a little bit. In 86, again, they increased the dividend. Payout ratio again declined. They only bought back a very small amount of stock. And again, the debt to cap this year actually went down, but they announced a target of about 35%, from 20 to 25%, up to 35% debt to cap. And then in 87, they again increased the dividend. The payout ratio went down. They announced that they were going to target a 40% payout ratio. So once they got to 40%, the dividend as a percent of EPS, they would kind of grow them in line with one another. They repurchased about 1% of their shares, and the debt to cap again was around 15%. So this is all the stuff that happened until in the years since new management took over, between then and when Buffett finally invested. So let's go next. So Buffett buys Coca-Cola. He really says that he purchased Coca-Cola first in 88. He read the 87 report and decided that was what convinced him to buy Coca-Cola. So what did Buffett see? So what we see is, we know that Coca-Cola was really refocused on its core soft drinks business. So they had gotten into this conglomerate business. They had gotten into, owning bottlers. They've gotten into the entertainment business. They've gotten into the foods business. And, they've slowly over the years gotten out of a lot of that stuff. Finally ending with the spinoff of Coca-Cola Enterprises, the bottler, as well as Columbia Pictures, the movie and TV production company. So they consolidated and sold the majority of their bottlers. They sold a majority stake in their entertainment business. Now, international continued to grow. So as you can see here, international was 2/3 of their soft drink volume. So it was the majority of the soft drinks business. And it was 77% of the total soft drink operating income. So it was 2/3 of the volume and 77% of the profits. So it was more profitable. It was the larger business, and it was more profitable than even the U.S. business. And then you can see that they talk about significant growth potential because per capita consumption is below the levels in the U.S. So that's actually pretty interesting, and we'll talk about that because that really feeds into what the long-term growth potential could have been. The last thing I'll say is, the international business, you can see here, they talk about volume growing at 9%, which is a pretty healthy volume growth. And they talk about a 16% strengthening of key currencies against the US dollar. So those two things together would aid to pretty, significant revenue growth. 9 plus 16 would be 25. Actual revenue was only up 13%, which basically implies that the real price or mix was really down about 10, 12%. So, really kind of not really pushing on price in the international markets yet. And we'll talk about that and why, when Coca-Cola decided to finally raise prices in the US or in international markets, it really kind of boosted their growth. So here's a chart. You can see here the international per capita consumption. This is again from the 87 annual report. So the United States, number 1, Mexico, number 2. I think, if I'm not mistaken, I think Mexico now consumes more Coca-Cola per capita than the US. And then all the way at the very bottom, you can see China, barely any consumption of Coca-Cola, even as early as or as late as 1987. In the U.S., again, the U.S. business was growing pretty nicely. Here you can see the revenue was growing at about 5%, and with 1% shipments, that basically implies that prices in the U.S. were up about 4%. Now you see about 1% shipment growth, but they actually go on and say that retail case sales advanced 6%. So the volumes that their customers were selling of Coca-Cola, the bottlers were selling, were up 6%. So that is a good indication that even end market demand was pretty healthy for Coca-Cola. So anyways, let's continue to move forward. So pretty healthy U.S. business. Now, they sold a majority stake in the bottlers, so they sold a 51% interest in Coca-Cola Enterprises in 86. And like you said, Coca-Cola Enterprises was about 45% of the volume. In 87, they did the same thing in Canada. They sold TCC Beverages. Again, they sold 51%. They retained 49%. TCC was about 70% of the Canadian volume. And, you can see at the bottom, the rationale they said is because the bottlers can utilize more leverage in their business because they have more, basically more hard assets, more factories and things like that. So they can use more debt than Coca-Cola would use in its own, in its own business. They also sold the majority stake in the entertainment business. So they merged Columbia with TriStar Pictures to form Columbia Pictures Entertainment. If you see a movie today, you'll see it says Columbia TriStar. And then just like what they did with the bottlers, they reduced the ownership to 49%. And again, they said that it was because this ownership structure allowed, each of the individual companies to adopt financial policies more appropriate for their business. In the balance sheet, if you look, here's where the carrying values are of the different investments. So Coca-Cola, Columbia Pictures Entertainment, about $1 billion. Coca-Cola Enterprises, about $70 million. TCC, about $85 million. And then other, which are the other bottlers that they were buying, about $435 million. And you can see that in the notes of the financial statements, they said the market value of the company's investments exceeded the carrying value, slightly by about $44 million. So these were pretty reasonable values on their balance sheet. And then, like we said, even though they'd spun off Coca-Cola Enterprises and TCC, they continued to invest in bottlers. So they were buying minority stakes in other bottlers. They created international JVs in Asia. They'd done the Cadbury Schweppes JV in the UK. They were creating bottling JVs in China. And then in the back, they even say the subsequent events. They bought Coca-Cola bottling of Memphis, and then they subsequently sold Memphis and the Miami bottlers to Coca-Cola Enterprises. So they were, again, consolidating more of the volume under Coca-Cola Enterprises. And then lastly, some capital allocation policy changes. So, we talked about that they increased their target debt to cap ratio to 35%. And so they say with the current ratio around 15%, they have about $1.2 billion of borrowing capacity. So, if a company is as we'll see, Coca-Cola was generating about 20% return on equity. So, and at the time, interest rates were about 9-10%. So it's pretty good if you can borrow money at 10% and reinvest it and make 20%. So that debt capacity was not a bad thing for them to have. They also said that, they're going to be more focused on their core business. So you can see, preferring investments within our existing lines of business and applying strict discipline in assessing potential investments. So basically, they were saying that they were going to stay more focused and be less, less wandering as they were in the early part of the 80s. And then they actually made another interesting statement. After repurchasing 10 million of shares in 86 and early 87, we announced plans in July 87 to repurchase over a 3-year period up to 40 million shares, more than 10% of the company's total number of outstanding shares. So they were basically telling you that they were going to start buying back their stock more aggressively. Here's a history. You can see the revenue and operating profit. So revenue, from 1977 to 1987, it grew. From 1980 to 1984, you can see it kind of flatline and then started to grow again, right? So why did it flatline? And it's really because the dollar and the strength of the US dollar. So if you look at this chart, you'll see that between 1980 and 1985, the dollar increased significantly. It actually went up about 64%. This is the price of the DXY dollar index. So basically, from 1980 to 1985, it went up 65%, or about 10% per year. And why did it do that? And it was really because of what was going on in the U.S. and inflation and Paul Volcker taking over the Fed. And so when he took over, he significantly raised interest rates well above the rate of inflation to really break the back of inflation. But because interest rates were really high and real interest rates were very high in the US, there was a lot of demand to put capital into the US because people wanted to benefit from these high rates of interest. And so, foreign investors flooded into the US financial markets. They bought dollars, so the dollar went up. And when the dollar goes up, if you have a business like Coca-Cola, which is selling a lot overseas in other currencies, which are effectively weakening, when you convert those, currencies back into the US, it doesn't look like as many dollars. And that's part of the reason, or a good chunk of the reason why Coca-Cola didn't look like their revenue was growing, was because the dollar was strengthening over that period. In 85, 86, there was something called the Plaza Accord, where the major countries of the world came together to really weaken the dollar. And you can see a big decline in the dollar, which continued in 87. And that's kind of why revenue for Coca-Cola really started to take off, because their international revenue started to look a lot better when the dollar started to decline. Now, over this whole time frame, you can see the red bars, which is the return on equity. And, basically the return on equity for Coca-Cola, a couple of years dips below 20%, but not that far below. And, most of the time is above 20%. And by 86, 87 is above 25%. So the returns on equity were pretty strong. And, I think one of the ways to judge it is you look at, what are the bond yields? So these are the yellow bars are the 30-year bond yield. So at no point in time was Coca-Cola earning less investing in their business than what they could have just invested if they just invested passively in bonds. And so you really were fine with Coca-Cola retaining earnings and keeping them in the business and earning returns on those retained earnings. And you can see this is kind of what they did, right? They maintained a pretty steady level of capital expenditures. The red lines, were well above the yellow lines, which is depreciation. So they were investing for growth. But they weren't investing so aggressively, kind of it stayed around 250 million to 350 million per year. So a steady amount of investment every year. And like I said, you were fine with it because Coca-Cola was still earning high returns in this business. You see they started using more debt. So, until 82, 83, they kind of kept the debt levels pretty stable. And then in 84, 85, 86, 87, debt started going up pretty steadily. Again, not as a large part of their capitalization because their earnings can continue to grow, but they started using more debt in the business. And then they talked about the dividend growing slower than earnings, and they actually did this. So the yellow line is the earnings per share. The red line is the dividends per share. And so in 82, the payout ratio, it's not listed here, but the dividend was about 61% of earnings, and by 87, it had gone to about 46% of earnings. So earnings had definitely grown a lot faster than the dividend. Now, the share count, over that decade was, even though there were a couple of times when Coca-Cola bought some stock, you can see it was flat for the first couple of years. It went up in 82, 83. That was mostly because of the acquisition of Columbia Pictures. It went down in 84, 85. They bought back a little bit of stock. In 86, it went up because of the bottlers, Beatrice and JTL, I believe, that they bought. In 87, it ticked down a little bit. But basically, over that decade, the share count was flat to up slightly. So let's talk about valuation, right? So we know that Buffett looks for a 10% pre-tax yield. This is from the 2002 annual report, and he basically says that we want a probability of at least 10% pre-tax earnings, which translate to 6.5 to 7% after corporate tax, right? And if we don't get that, we'll sit on the sidelines. So that's from the 2002 letter to shareholders for Berkshire Hathaway. So why does he want a 10% pre-tax yield, right? So in theory, if the stock was trading at that level, you could borrow, that market cap, and pay it out as a dividend to shareholders, assuming interest rates were 10% or less, right? So shareholders would recoup 100% of their investment and still, basically still own the business, still benefit from future growth. Now, if we remember, when we go back and think about what we talked about with Benjamin Graham and the margin of safety, right? Ben Graham defined margin of safety as an earnings yield greater than bond yields, right? In this case, I think Buffett is saying basically the same thing, an earnings yield greater or potentially equal to where bond yields are, right? In the Intelligent Investor, when we're talking about margin of safety, it talked about the example of the company National Presto, which again was trading at a very high earnings yield. The other thing that's interesting is, when you look at it in the 80s, corporate tax rates were actually pretty high. They were 35 to 40%. And so even with 10% debt cost, the after-tax cost of debt was really 6.5 to 7%. So, that again foots with the 6 to 7% after-tax, after-tax yield that you're earning in equities. So basically, the way I think about it is what Buffett says is like, I'm looking for a really attractive bond, right? A really attractive bond where I have the option for growth. Now, as we said, they had significant non-core assets. If you look at the balance sheet, they had about $1.4 billion, almost $1.5 billion of cash and marketable securities, up pretty significantly from 1986, where they had about $868 million. They had something else. They had a note receivable from Columbia Pictures, basically money that they were going to get back from Columbia Pictures, $544 million. So if you add those two things up, they had over $2 billion of cash and investments. And then, what we talked about before, they had these investments in affiliates, so Columbia Pictures, Coca-Cola Enterprises, TCC, and the other bondholders. And that adds up to about over $2.5 billion, or yeah, I think about $2 billion and change. Now, a couple other things. In 1987, they took a $36 million restructuring charge for their underperforming foods division. Like we said, cash and marketable securities had increased to over $2 billion, which was basically more cash than Coca-Cola really needed to operate the business. And how can we see that? Well, one way I think is useful is we look at history and we look at how much cash and investments they had as a percent of revenue. And if you look at 87, they were above 25%. But if you look at the few years before, they kind of kept cash and investments between 10 to 15%. So if we assume that, basically they have, they needed about 12.5% of revenue as cash, and a little over 25. So basically they had twice the amount of cash that they needed. So, that's why I say they have about $1 billion of excess cash. So Buffett buys in 88. He buys $593 million of stock. His average price is $10.45. That's split adjusted. For the splits only in 92. I think if you adjust for all the splits today, his cost is around like $2. And what we'll see is that he paid about 9 to 10% pre-tax earnings yield, or 6% after tax. So really within that threshold of what he talked about in the 2002 annual letter. In 88, the yield on 10-year treasuries was about 9%. So you're basically buying Coca-Cola as if it was a 30-year treasury bond with the benefit of future growth. So these are all the numbers from the 87 annual report. You can see the operating income. That's just the number that they report in the income statement. Under the adjusted line item, I add the 36 million back for the restructuring to assume that that was one time. They have 118 million of equity income. So basically, Coca-Cola's share of the net earnings for the affiliates. So what was its share of the earnings from Columbia Pictures, from Coca-Cola Enterprises, from the other bottlers? Now, because those were publicly traded, when I look here, I kind of look at the value of the company, excluding the value of the investments, because at least in theory, Coca-Cola could have dividended those out to shareholders. And because they had a market value, the market value was about $2.3 billion. Similarly, they could take $1 billion of cash from their balance sheet and dividend that out to shareholders, which is why if they did that, the interest income would go down from about 207 million to, kind of, let's say roughly half, so $104 million. Interest expense would stay the same because the debt wasn't changing. They had a $40 million gain on sale of stock, which I basically zeroed out, again, assuming that that's not part of the core business. And so you can see that the adjusted pre-tax income for Coca-Cola in 87 was 1.185 billion, and then if you back out the taxes, was about 732 million. So we know that Buffett bought it at $10.45. There was 1.488 billion shares, again split adjusted at the time. So the market cap of Coca-Cola was $15.5 billion. Like I said, in that $15.5 billion, you had 2.3 billion of investments. That was again Columbia Pictures, the 49% of Columbia Pictures that they still own, the 49% of Coca-Cola Enterprises, the 49% of TCC, and then the other bottlers, and then $1 billion of excess cash. So you were buying the core business for about $12.2 billion. So again, if you take it on an adjusted pre-tax earnings yield, so the 1.185 over the 12.2 billion, it's about a 9.7, almost a 10% pre-tax yield. Sorry about that, and then 6% sort of after tax. So really within that, right within that kind of target range that Buffett talks about. So he buys more stock in 89. He bought another 431 million shares in 89. He paid an average price of 11.75. And you can see the same thing. He paid about 10 to 11% pre-tax earnings yield or 7% after tax. So in 89, again, these are using the 88 reported numbers. Again, you can sort of see the same thing. This is the operating income. There was no restructuring that year. Again, we zero out the equity income because we're going to assume that all the investments get spun off to shareholders. In that year, interest income was 199 million. I keep it at that level because the cash balance had gone down. At that point, Coca-Cola probably did not have any excess cash. Interest expense, you keep it as is. Other expense was 33 million. I just leave that as is to be conservative. And so you can see, again, you're buying the core business of Coca-Cola for about $14 billion, which was, again, a 10.9% pre-tax yield or 7% after tax. So Buffett buys one last time in 94. He buys 275 million of stock. He pays $41.66. And he paid about a 6% pre-tax earnings yield. And this one is a little bit harder to explain because it doesn't really fit his rule. The only thing that I've been able to deduce is, he was around 90 some odd million shares, and he kind of bought enough to own 100 million shares, a round number, which after the splits is now 400 million, which is the same amount of shares that Berkshire Hathaway owns of Coca-Cola even today. So after 94, he never bought another share of Coca-Cola in his life. So pretty interesting. So that's the valuation side. Now let's talk really quickly about growth. So we talked about the international per capita consumption. So this is how the charts looked in 87. Obviously the US was the leader, and China was barely non-existent. And even by 92, you can see here they put some numbers on it. So the average person in the US consumed 296 servings of Coca-Cola. The international average was 40. China was 1 and India was 0. So, potentially a lot of people, still hadn't consumed Coca-Cola. Um, Now, what's interesting about Coke is it's really an affordable product that even people, even consumers, could buy even in less well-off countries. As you can see, even in Mexico, there's a lot of consumption of Coca-Cola. So really significant potential if they could get to U.S. per capita consumption levels, right? In certain countries like Mexico, Norway, Australia, we're getting there. I think something interesting just about when people talk about international growth, sometimes you have to think about things like affordability and stuff like that. But Coke was an affordable product pretty much around the world. Now, pricing power is the other kind of big important secret. So, Coke had raised U.S. prices about 3 to 4% per year, but historically hadn't raised international prices. International growth had really been driven by volume, and U.S. prices had kind of lagged behind inflation. So even when raising prices 3 to 4%, we were in a time when inflation was much higher. And so really that's what drove the growth in the 90s was both the strong volume growth as well as the price increases that they had done. Um, okay, let me restart the share. Um, so here we were talking about the growth and the potential for growth that Coca-Cola had. So pricing power, um, Coke had raised prices in the U.S., but has historically hadn't raised prices in international markets. International, as we've seen, was historically driven by volume. And even in the U.S., the prices of like 3 to 4%, this is in the time in the 80s when prices were, inflation was much higher. So even the prices in the U.S. had lagged. And so really what we'll see is that a lot of the growth that happened in the 90s really was driven by continued volume growth, primarily in the international markets, as well as price increases both in the U.S. as well as in international markets. And then lastly, was Buffett also betting on lower interest rates? Um, so if you look between 87 and 89, inflation as measured by the CPI was running around 4 to 4.5%. Now interest rates were pretty high; they were 8.5 to 9%. And part of the reason why is the Fed had just won the fight against inflation and was really trying to maintain its inflation fighting credibility. So they kept rates pretty high. This is kind of the end of the last few years of the Volcker Fed and the first few years of the Greenspan Fed. And so if you really think about it, when, a good rule of thumb is really treasury yields should be kind of like the inflation rate, so 4 to 4.5% plus at most maybe like 2%, sort of a real interest rate, which would imply kind of treasury rates of around 6.5% or more reasonable. And what did we see? Well, interest rates did decline, but took a while, slowly. So 30-year yields were still around 9%, 9 to 9.5%, and kind of stayed around that range, fell to 8%, and really didn't fall down to 6% until late '93, and then